Welcome to the Allan Small Financial Show. As always, I want to thank everybody for taking time out of their busy day and spending some time with us. I think today's show comes at a fantastic time. I've been talking to a lot of individual investors, and all I seem to hear lately is the world is a crazy place. The world is an unsafe place, and a lot of people are nervous about the path that the United States is on or that Canada is on, and they're concerned about their investments. They're concerned about many things right now, and so having a show today to answer many of the questions that I think that is on the minds of individual investors. I think is fantastic to have this show today. And let's put up the topics for our show and you'll see what I mean. Our first topic: who was making trades in the futures market as the Iran situation unfolded? I received calls, either or emails or text messages late Sunday night, early Monday morning, when it was the news came out obviously over the weekend that there was a war breaking out in the Middle East, the United States, Israel, versus Iran, attacking Iran. And the futures markets overnight started to reflect that. They started to sell off. Even more reflective of the war were the markets overnight, Monday into Tuesday morning. A bigger decrease in the markets. And individual investors woke up to the media talking about 1,000-point decline, 1,200-point decline, etc. And it really spooked individual investors. And so we're going to talk about who is making these trades and why these markets are showing such negativity even before the overall market opens up in North America at 9:30 a.m. As always, our top 3 things to consider over the next 5 to 10 business days. Very popular segment with our show for individual investors to know what to focus on before they make their investment decisions. February, a rough month for the markets. We had a decent January, up 1% or 2%, and unfortunately, February gave most of that, if not all of that, back. And we tend to see February being a bit of more of a difficult month for the general markets than January is. But as we know, as goes January, tends to go the rest of the year. So the good news is we saw some positive numbers for January. So keeping that in mind, as goes January, goes the rest of the year. So I think 70% roughly of the time, we should see a positive year for 2026. CEO reactions to AI. I've talked about AI and its disruptiveness with respect to the markets. Well, CEOs are starting to weigh in now and starting to say some of their concerns with respect to AI. It's definitely not all positives and benefits. There are some disruptive capabilities that AI has to disrupt the markets, disrupt business in general. State of the American economy. How's the American economy doing? And yes, we talk about the American economy quite often. It tends to be the economy, whether it's Canada or US, it's the US economy that tends to move the stock market, even the Toronto stock market, more so than how the Canadian economy is doing. We know the Canadian economy has been relatively stagnant for quite some time, and we're hoping that our government can do the right things to improve that. Quick hits, a couple of different things, 3 things actually, that I've noticed in the news as of late that I'd like to comment on. And lastly, your questions. If you have any questions during the course of the show, please put them in the chat boxes. My assistants will go out, pick up those questions, and hopefully I can answer at least 1 or 2 of your questions that come in during the show. If not, I'm going to probably get to some questions that I've received over the last couple of weeks. So without further ado, let's move on with our first topic for this week's show. So Monday morning comes around and I get a bunch of text messages or emails, and people are saying, oh, it's going to be a bad day. And they're basing that a comment on, I guess, obviously the war that broke out over the weekend on Saturday, early morning Saturday. And, they were looking at the futures markets, and the futures markets that come out in the US. They give us an indication how the overall markets will begin trading come Monday morning. And futures markets start off when the Asian markets open up Sunday evening. You kind of get a feel for how those markets are doing, and then those futures markets in the U.S. And they tell us, what's going on, what the sentiment is with respect to being positive or negative. But I think individual investors, they also want to know who is doing these trades, who are making these trades, why are the markets moving even before 9:30 comes, and even when the markets do open, how or who is doing the selling in this case? Because we know Monday morning comes along and we obviously get selling in the market, which, thankfully by midday, that selling reversed to buying. And we saw the markets end up relatively flat for Monday. Tuesday, yesterday, we saw markets sell off once again overnight into Tuesday morning. Tuesday morning, we saw markets drop. The Dow, I think, at one point, 1,200 points. The S&P 500 down about 150 points. And the TSX down close to 1,000 points as well, or in around 1,000 points. So who are doing these trades and who has access to these markets? Well, access to the markets, not all of us do. And in fact, very few individuals or firms have access to the futures market. Very few investment firms can trade after 4 p.m. or before 9:30 when the market is available. I think I've heard rumblings that eventually we're going to be able to trade stocks all day long, 24 hours a day. And that hasn't happened as yet, but I wouldn't be surprised if that happens down the road. But in the meantime, it's those individual firms that are able to take positions before the market opens and that they dictate what the futures look like. Obviously, the volumes of these trades are quite small in comparison to the volumes that happen during the regular trading day, which in North America, 9:30 to 4 p.m. So we tend to see market movement there. A lot of clients also, or individual investors also want to know how these markets move so quickly. Market opens up at 9:30 a.m. and boom, market's down 500 points even before anybody could blink. And the answer to that question is maybe not what most people think. It's not individual investors making these sell trades. It's not even investment advisors like myself or mutual funds or hedge funds. Maybe some of the trades are done by mutual fund or hedge funds if they have access to the markets prior to 9:30, or they have access to algorithmic trades or computerized trades, because it is the computers. The computers are the ones putting through these trades, and they do it at an incredible speed based on many different factors, depending on what the price of the market is at, individual stocks is at. They also can do trades based on headlines. And I think that is where we got or received most of our trades over the past few days. Algorithmic trades or programs designed to search for positive or negative, in this case, headlines. And what we saw obviously over the weekend were extremely negative headlines. When a war breaks out, doesn't matter who's winning or who's losing or what the stakes are, a war to the market is negative. And for the most part, because you're going to see a little bit later that for some sectors of the market, a war actually can be positive. But for the general indices, whether it's the S&P 500, the NASDAQ, TSX, a war is negative headline. So let's go to our first chart here, which is on algorithmic trading. So these are the algorithms. These are those individuals that sit atop the Goldman Sachs building in New York. And these are individuals that come out of university or post-secondary schooling with a math degree, and they design these algorithm programs. They set it up so that if something happens in the market, a cascade of sells goes off, or a cascade of buys go off, sell, 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 sell. You see the market go from up 100 to down 100 in a matter of seconds. And that's who is controlling these markets, especially when we have the unpredictability of a war. And you can see here, a lot of factors go into these algorithms, these algorithm trading, data sources. When you have the data, whether it's market data, historical trades, what I refer to as news and sentiment, the headlines that we received over the weekend, that The algorithms pick up on that company data or any other data for that matter. It could be data with respect to the dollar, or it could be yields on a 10-year bond from the United States. Then what happens? Obviously, these algorithms, they form a model, and they have graphs, and they have a decision tree and logic. And what does the execution do? Well, as you can see in that little underneath the execution green square, speed, frequency of how long they should trade, or how quick they should trade, and the holding period and the size of the trades, all that goes into these algorithms. And last but not least, the monitoring of the algorithms. What's the objective? What's the function of these trades? Performance versus benchmark. If you make a lot of money very quickly, does an algorithm then, is there an algorithm that goes off that says sell? And if the market keeps going down, maybe the algorithm goes from sell to buy. So the answer to the question, who is doing the selling? When you call your investment advisor and they say, probably the best thing is to do nothing when you wake up on a Monday morning where a war breaks out. And they're telling you that because that's what they believe, that this is just a bit of chaos that happens due to the program trades, the algorithm programs. But eventually, these things iron themselves out over a longer period. And we see that instability. And often I tell investors, let's take a step back. 24-hour rule. Let's not buy. Let's not sell. Nothing has really changed with respect to the companies that we own, with respect to the mutual funds or the bonds or whatever investments you're owning. It's just all that algorithmic trading that is based off of, in this case, headlines. That's what's affecting the market. Our next chart and second chart for this, it's actually not a chart, it's more of a quote. We can put it up. There you have it. How prevalent is automated trading? Estimates suggest that between 60 to 70% of the trades that are being conducted now are done algorithmically, meaning that the vast majority of trades are decided by automated trading systems. These models have enormous potential, enabling firms to capitalize on speed, efficiency, and data processing capacity far beyond human capabilities. And so, someone like me, I just can't press the sell button fast enough for us to actually sell the way what you're seeing, to explain what you're seeing on the markets. Nobody can. And it's not the retail investor. It's not even the mutual fund or the hedge fund person. It's more likely these algorithmic trades programs that are designed to pick up headlines, negative or positive, that are doing these trades. So before you think to yourself, on a day where things are falling quite rapidly and the sentiment is quite negative, before you tell yourself, oh my goodness, everybody is selling, we got to get out, that's not necessarily true. It may be that no one is selling and it's just the computer programs that are doing all the selling because they were designed many, perhaps weeks or months ago, to pick up on certain data, and that is why the market is selling and selling quite rapidly. And you'll always be able to detect when a sell program or a buy program is activated because trades happen very quickly and the market's reaction can go up or down quite a bit in a very short period of time. So yes, algorithmic trades are now a big part of what we see and discuss every day. But again, over the long term, I do believe that things always have a way of settling down, and that the average investor, through their investment advisor, can always figure out what to do over the longer term. Just don't be so quick to respond emotionally if you see markets moving rapidly on a Monday morning, as an example. Now the part of our show where we discuss three things that I think individual investors should be focusing on before you make your investment decisions. And here we have our three for our show today. Investment ideas that surge or fall during wartime. As I mentioned off the top of the show, war is usually bad for the markets, but there are certain segments or sectors of the market that benefit and go higher when a war like we're seeing now in the Middle East breaks out. We'll talk about what are the ones that are going up, what sectors, and the ones obviously that we're seeing negative effects on. Economic indicators to watch. There always seems to be economic data coming out. We have some economic data coming out the end of this week, early next week, and late next week when the Canadian jobs report comes out, I believe, next Friday, so 1 week from today. Law of large numbers. What does that mean? Well, simply put, the larger the number, the more you could see a bigger sell-off number or perhaps an increase in number. But if you take it as a percentage, it really isn't a big thing. And I'll explain what I mean shortly. So let's move to our first top three idea, which is investments that surge or fall during wartime. So there you have it, a nice little illustration there with a barrel of oil. Yes, of course, oil would be one of the sectors of the economy that will be affected if there is a war that breaks out in the Middle East. So, of course, war breaks out between US, Israel, and Iran, and the price of oil, of course, moves up. Now, I don't think, to me, I don't think the interesting thing is that oil moved higher. To me, I think is by how much it moved higher. And to me, it didn't move higher much at all. I don't think the price of oil moved that much to the upside. Perhaps if this war broke out 20 years ago, you might have seen WTI, which is the oil price in America, in the US. You may have seen that $90 to $100 a barrel. I think at the highest point in the last couple of days, it got up to maybe 77, up from about 67, where it was trading prior to the war breaking out. And today, before I came on air, it was actually negative. Price of oil was down. I think it's down somewhere around $73, $74 a barrel. Our first chart that we have shows oil prices and how they spiked. There you have it. Brent crude is the oil price in Europe, and it's always a little bit higher than WTI, which is a little bit higher usually than our oil price here in Canada, Western Canadian Select. And so here you have Brent crude spiking up to almost 80. It actually passed $80 yesterday. And WTI got as high as 76, 77, and now has pulled back into the low 70s once again. So here you see a sector of the market benefiting from the war. I don't like to use the word benefiting, but price of oil going higher. So obviously, anyone who's invested in oil or oil stocks would have seen their share prices or prices in general move higher. Next chart here is just on WTI crude. And you can see on March the 2nd, you see that straight line up. That was a gap up in oil prices. That was the Monday that just passed. And you can see really oil kind of floundering and spiking higher yesterday, but has come right back down again as announcements are made regarding the war, how the war is going, what the U.S. has done to guarantee passage through the Strait of Hormuz, which is a very narrow passageway for oil tankers to get through. We know that 20% of the world's oil goes through that strait, and Iran initially said that they're going to block it, that anyone traveling through it would get blown up or set on fire. Well, the United States yesterday said, if you're going to go through, you will have a Navy escort, a United States Navy escort. They also helped with respect to insurance on these vessels, saying that they would cover that as well. So when that was heard yesterday, price of oil fell significantly. What else goes higher when a war breaks out? As you can imagine, what goes higher anytime there's more chaos in the world? The price of gold. Our next chart is a price of gold. And again, as you can see, beginning of March, kind of just off center a little bit towards the right center of your chart there, a straight line up. And again, we saw gold moving higher temporarily, comes back down, moves again higher at the start of trade yesterday, and then right back down again, because once again, situation, it's one of those things you fire first and ask questions later. So right away, gold, I should say, moves higher along with oil. And then, level heads prevail and people start looking at selling off gold a little bit after they have that initial burst. And we saw gold prices get up to 5,400 an ounce. And today, as I said, sitting somewhere 51, 5,200. Next chart here shows another sector of the markets that you may not think about as much, This is the aerospace and defense sector. These are predominantly U.S. defense companies. Again, March 2nd comes. Look at that straight line up for the defense stocks. Northrop Grumman, General Dynamics, L3 Harris, RTX, and last but definitely not least, Lockheed Martin, the company that makes the F-16s and the fighter jets and helps make the Patriot missiles that defend Israel and other countries around the world. Defense companies spike higher, and then they get a bit of a reprieve. They go back down, give back some of the gains, like gold, and move higher once again. And now, showing some stability, we know that defense spending has gone up since President Trump took office because he's vowed to build up the military again, and he is forcing countries around the world to spend more on defense, up to 5% GDP on defense. And so who reaps the rewards of that? Defense companies. What sectors of the market go down? Well, many of them, but obviously just highlighting a few. Invesco QQQ, our next chart, is one for tech stocks. So on March 2nd or 3rd, we saw tech stocks fall, but have since rapidly recovered as the market has started to gain a little momentum. Perhaps the worst may be over. Perhaps the war that was rumored could take maybe as much as 4 to 5 weeks. Maybe it's going to be over a lot sooner. We heard some rumors today that Iran has been reaching out to the United States through back channels saying, what can they do to end this war? So if that is true, maybe the war ends a lot sooner than some people, even the president, had anticipated. Another sector of the market that goes down when a war breaks out, which is quite logical, which would be your airline stocks. We have the Jets ETF. No, it's not the New York Jets in football. It is the Jets ETF. I love that JETS represents the airlines, and a great ETF there. And you can see that the airlines have fallen. Why? Well, obviously they're not able to fly in certain areas of the world because of the war, and that is obviously affecting the airline stocks. Last but not least, for this part of our top three, we have the overall segments, our sectors of the economy. There you have it. I think probably the most important thing to point out is a 3-month sector performance, which is right in the middle of the energy sector, up 25.8% over the last 3 months. Over the last month, almost 11% higher. That is the big winner when it comes to this war and which sector has been going up the most. So you want to be mindful when you're making your individual investment decisions. What sectors make sense at the start of a war? Which ones may start to sell off a little bit, sell off from those highs as the war keeps moving on. And so building out a portfolio, these are the things that I believe you need to keep in mind. Our second point or investment idea that you need to be focusing on when you create your portfolios at this point in time, which is economic indicators to watch. And we can show that, yes, jobs and CPI. We're going to get jobs data out of the US. That is coming this Friday. Our first chart shows how jobs have fared in the US on a monthly basis. You can see January was a fantastic number. I think I would not be surprised to see if that is altered and maybe the number wasn't as high as first indicated. But 130,000 jobs created in January. The expectation is for about half that for the month of February. U.S. Consumer Price Index, CPI, that's going to be released early next week. And CPI was quite tame the last time it came out, showing an overall increase. We can put that chart up on U.S. Consumer Price Index. There it is. 0.2% increase, or about 2.5%. And the interesting thing is, if we show our next chart, PCE, which is the more favorable way of looking at inflation for the Federal Reserve, they're showing the PCE numbers, personal consumption and expenditures, are actually showing a higher rate of inflation, closer to 3%. So it's going to be quite interesting to see what the CPI numbers look like come next week. Will it be in and around 2.5%? And not sure why the PCE is showing much a larger number. Perhaps the PCE we know doesn't take into account as much real estate, whereas CPI has a bigger real estate component to it. And we know real estate prices have been falling in the US and even here in our country. So maybe that has brought down inflation in the US. But overall, I think we're going to be looking for what CPI numbers come out now and relate them to the PCE numbers we got not that long ago. And I will mention, even though we don't have a chart on it, but as I said, we're going to get some jobs data from Canada at the end of next week, next Friday, and that's going to be important for the Bank of Canada to think about interest rate policy, I'm sure, and obviously important to our government as well. Our third topic to look at, consider, focus on is the topic of the law of large numbers. So what do I mean about the law of large numbers? Well, the best way to explain it is by showing you a chart of the Dow Jones. We can pull that up. There you have it. The Dow Jones down 400 points at this chart where this chart was taken. At one point yesterday, the Dow Jones was down about 1,200 points. But let's consider law of large numbers. When the Dow is down 500 points on a 50,000 point index, well, that's 1%. In this case, a little less than 1%. When you look at these big numbers and when people see the Dow down 1,200, the S&P down 160, people start to panic. Emotion takes hold. Oh my goodness, down over 1,000 points. But down over 1,000 points is nowhere near what down 1,000 points was years ago when the Dow was, 20,000, 30,000 even. Today, the Dow is in and around 50,000 points. You lose 1,000 points, you're down 1%. That 1% could be made back the next day or over a couple of days. It's not a reason to panic and make a silly decision. Let's look at the S&P index next. We can see here, look at the S&P trading just under 7,000 right now. So when you see the S&P down, in this case 65 points, it's less than 1%. Back, I guess, in 2020, when the S&P was closer to 2,500 points, 65 points would be a much larger percentage. So always look at these indices in terms of percentage. The law of large numbers says, obviously, the bigger you go, the bigger movements point-wise you're going to get, but it doesn't mean you're losing more money as a percentage. And I always tell individual investors, don't think in point terms, think in percentage terms. Our next chart is the TSX. You can see here, TSX right now sitting at around 34,000. Once again, what does a 500-point decline mean, to the TSX? Obviously, a lot less than what it have meant, many years ago, or maybe even just a few years ago, back in 2020, prior to COVID. The last thing I wanted to mention with regards to the law of large numbers, we could also see large numbers factor into earnings. Our next chart, or our last chart for this segment, is one on NVIDIA. Look at that chart on NVIDIA. Look how it's basically been trading in a range for quite some time now. You're going to have to go back maybe 8-10 months to see a surge in the stock. Again, law of large numbers. You're going to have to really impress if you're NVIDIA to see this stock move to the next level. The bigger they get, the higher their profitability, their margins, their market capitalization. Almost just under a $4 trillion company at one point, or almost a $5 trillion company. This is a company now where the bar is set so high that even when they report blowout earnings, margins in 75, 77%, basically representing 7% of the S&P 500, what's it going to take to move NVIDIA stock higher? You're going to have blowout numbers. They had blowout numbers, and the stock still didn't move higher. So difficult to say what moves the needle with NVIDIA. But once again, when the bar is set high, when your stock and your company itself has gotten so large, it becomes very difficult to move the needle. So don't forget, when you're investing, the law of large numbers. What's it going to take for the markets to move to the next level? What's it going to take for a stock like NVIDIA to go to the next level? And keep in mind, if you do see sell-offs happen or even large movements to the upside, look at the percentage growth or percentage loss. Don't look at the overall number, because in my opinion, when you look at just numbers, it becomes an emotional thing and you may make the wrong decisions based on the numbers themselves. February was a rough month for the markets. Talking to individual investors last month, as I do, many investors, people were saying, Allan, what's going on with the market this year? Everything is down. Everything is down. Well, it was down for February, but not really down for the year. It was kind of flat. Markets trended a little bit lower recently. Obviously, markets have pulled back because of the war in the Middle East. But for many investors, they're actually up a little bit, maybe 1 or 2%, maybe a little bit more, depending on the mix of assets that they have in their portfolio. If they own some gold, if they own some tech, tech has gone up. Which tech? Obviously, there's a big discrepancy between software stocks and semiconductors or chip makers, chip equipment makers. There's a big discrepancy within technology itself. Of course, as we've spoken about on our last show, software stocks have been taking it on the chin now for pretty much for the last month or so. So yes, February was a rough month. We have a chart to show you the returns for February, and you can see them there. 520-point decline on the Dow, about 30-point decline on the S&P, and about 210-point decline on the NASDAQ. Once again, are these big numbers? Well, not really. It equates to less than a percent decline on the NASDAQ, a 1% decline on the Dow, and what, 0.5% decline on the S&P. So even though the numbers may show or may say that it was a rough month, I think obviously individual stocks themselves may have been up or down. Again, software stocks were down a lot more than 1%, whether you were Microsoft, whether it was Salesforce, ServiceNow, or any of the cybersecurity names, Palo Alto, CrowdStrike, etc. Those had a bit of a rough ride. But if you were other companies in the tech space, or gold, or industrials, or pharma, you fared a lot better. I think our next chart really shows the volatility that we've seen this year so far. There you have the S&P 500. Wow, look at that. Look at all those peaks and valleys. And that is just this year. Unbelievable. The swings that we've seen based on AI, tariffs, war, the threat of war at first, now the existence of war in the Middle East, oil prices spiking, then coming down, tech stocks coming down, and now rebounding slightly. We've seen many different areas of the market going up, going down, the geopolitics, the announcements out of Washington, the Supreme Court, striking down the tariffs, and then President Trump putting on 10% tariffs right across the board on every country, and now saying that he's going to increase that to 15% tariffs. All of this, and not to mention the debt levels that have increased either from private equity companies or publicly traded companies, borrowing money to build data center infrastructure right now, and the worry that these companies are taking on too much debt. All of this has caused the market to look like that. But make no mistake about it, as I showed you in the previous chart, even with the ups and downs, net coming out of February, you were down 1% at the most, and some indices were down less than that. So let's not get caught up once again in what's going on, what the media is saying, the numbers that we're seeing, the ups and downs of the market. We need to focus on the net result and the end result, which is, yes, we had a bit of a negative February coming off a bit of a positive January. Let's see what March brings. Obviously, there's a war going on, but the market is resilient. And let's see how the market fares for the month of March. So we've discussed already on a previous show the disruptiveness of AI. Many of us thought AI was going to be this great thing, and it is. I think if you talk to most people, they'll say it's amazing. It's going to revolutionize the way we work and communicate and do business, and how the kind of research we can do, the kind of medical breakthroughs we can have using artificial intelligence, how quickly we have access to knowledge and information. It's amazing. But there are obviously negative effects on all of this. We're hearing about some of those negative effects now, the negative effects on certain industries in the economy, the effects on jobs and job creation and job growth. Perhaps businesses don't need to hire as much because AI is going to do the job of 10, 15, perhaps hundreds of employees. We heard some companies recently laying off percentages of their staff, not just 100 staff, but in the thousands. 40% of their staff. Block, which is a company that some of you may know, I believe they just announced that they're laying off 40% of their workers at the company. They just don't need them anymore. They believe that AI can replace what these workers are doing. So is it good for the people? Obviously not. Good for the business because now they have reduced headcount, which reduce costs. So our first chart in this segment shows that the share of CEOs who say select risks will have a high impact on their industry. So this is a survey of CEOs, 500 CEOs. Actually, most recently, about 142 CEOs conducted this survey beginning of February. And at one point, geopolitics was the most or the biggest concern for CEOs. 59% of those surveyed said that was the biggest concern. But you can see how quickly this pink line has moved higher. And that is the AI concern. Now that is sitting at 60%. The chart almost looks like a hockey stick, right? You have the blade of the stick and then straight up. So it is telling you that AI is now on the radar for CEOs, on the minds of CEOs. And you see other things there, cyber, financial and economic, legal and regulatory rounds out this chart. But right now, AI definitely on the minds of CEOs, depending on what sector you're in. You could be in trucking and you saw your share price fall because there's a risk that AI could develop some sort of plug-in initiative, program, chatbot, robot that is going to compete with the software in your trucking industry, and that you won't need as many people there to do the work, and you will see layoffs, and businesses won't need what the different things that the freight forwarders offer to the people, and they'll have to cut their prices and cut what they do down, and obviously will be less profitable. So what can businesses do? What do CEOs do when they see their stock price fall because of certain risks to their company? Well, one of the things they can do, and we call this a fancy term, it's called financial engineering. And for the longest time, we heard IBM doing this, which is buy back their own stock. If you believe that your share prices are low, but low for the wrong reason, and as a CEO that your shares should be a lot higher, what do? Well, you take the cash that you have, a portion of it, and you go into the open market and you buy back your own stock. Take it out of the market. Obviously, based on a supply-demand dynamic, if there are less shares out there in the open market than before, that helps your stock price move higher. You could also increase the dividend that you are paying if you are paying a dividend, or initiate a dividend from on the shares that are outstanding. So two ways that you could get people excited about buying your stock or your company shares. Our next illustration shows that 85.7 billion, that's euros, the value of stock buybacks announced by companies in the stocks Europe 600 index this year, the largest index in Europe, the highest ever for the January-February period, according to a Barclays tracker. 85.7 billion. That means companies have never bought back more stock ever. And it's unbelievable because companies believe that they're being sold off, their shares are being sold off unfairly. You look at the chart underneath it, buyback announcers outperform. The cohort beats market and dividend aristocrats in past 6 months. So as I said, you can issue a dividend. That helps get your share price higher as well. But if you look at the black line there, the Barclays EU buyback basket, that is the black line. You could see that the stocks or the companies that have bought back their shares have fared better, a lot better than the gray line, which is your dividend payers, and the overall index, which is your yellow line. And we know the European indices have been doing quite well over the past few months, better than even the indices here in North America. Lastly, I want to point out one company that we've seen get hit quite hard. The company name is Salesforce. There you have it. You can see the chart. When it came out that some of these AI companies, Anthropic and their AI Claude, came out with some new plugins that were going to change the way people build out their CRM systems, which is what Salesforce is, build out their marketing campaigns, which is what CRM or Salesforce does. When you could basically create your own system out of nothing from some program or technology from Anthropic or Claude, then why do you need Salesforce? Salesforce would then have less to offer businesses and would have to cut prices, and profitability would go down. And that's what you're seeing with Salesforce. So what did Salesforce announce? They announced a $50 billion buyback, $50 billion share buyback. The company itself is worth about 180 billion. So they're going to buy back just under a third of its value in shares. That is incredible. Normally, that would create a huge response. The market would respond quite rapidly to the upside, but we didn't see that. Lately, we're seeing Salesforce stock move up a little bit, as you can see on this chart on the far right-hand side. It's finally started to gain some traction, but not nearly what I would have expected. So share buybacks is something that you're seeing more and more of for certain companies. And to me, this is something to keep an eye on. It's a very big positive for certain companies. We call it financial playing around or playing around with the numbers, as we like to say, and trying to make shares attractive. IBM was famous for this for many years. And I think for all of us, we just need to keep in mind which companies are paying good dividends and which companies are buying back stock. So the state of the American economy, I would say, is mixed at best. You have a lot of positive data, and you have a lot of data that I would say is softening or is already soft as we see it. And I guess it just depends on who you talk to or what someone decides to focus on will dictate whether they think the American economy is doing well or not. Our first chart that we have here shows the S&P 500. How much it's climbed in the past year. You could see, based on the stock market performance, one would say that things are pretty good. You see here, April 9th, Trump walks back his most severe tariff proposals, boosting the stock market. And I guess the stock market hasn't really looked back. It has its ups and downs, but overall, if you base how the American economy is doing, which President Trump tends to do, based on the S&P 500 performance, you would say that things are pretty good. Our next chart is one about GDP. And you can see that GDP, overall change in real GDP, annualized 1.4% was our reading for this past month in the United States. Not nearly as high as I think the president would like to see, but we know that that very brief government shutdown in the US probably cost that number maybe a half to a full percentage point. So I think the real GDP number would have been somewhere around 2.5%, maybe a little bit less. And that was expected. I know some, I guess a little while ago, were thinking that maybe you could see as high as a 3 to 4% GDP print. We saw GDP last quarter in the US came in a lot higher, as you can see, somewhere around in and around 4%, 3-4%. And I think many thought that GDP would show the same number for this past month. Tracking U.S. jobs year over year. That's our next chart. And you can see, yes, there are growing jobs in the U.S., but you could see a steady decline. And I guess coming out of COVID, that is our biggest number there in just after the COVID in 2021, 2022 lower, 23 lower, 24. And, you could see, our number now, 130,000 jobs created. Sorry, my apologies. Yes, that was the number, 130,000 jobs created the last look in Jan. We're going to get a February number now, and it's expected to be half of that. So again, a bit of a pullback in jobs. Our next chart that we can look at, wage growth versus inflation. Yes, wage growth is above the inflation rate, which is 2.4%. Annual percent change in average earnings or and then versus the average annual inflation rate. So we got 3.7 versus 2.4. So yes, it's above, but yes, it's also starting to soften and come down. Is that something that the president wants to see? Absolutely not. He actually brags about how much wages have gone up versus inflation, and that the inflation where it's at right now is affordable to the average person in the US because wages have gone up. The next chart that we have, tracking US consumer sentiment. This is actually quite important because this tells us how the average US consumer feels. And we know the consumer in the US makes up about 70% of the market. So once again, it is above where it was back in June 2022, which was a historical low. But again, it has fallen since the end of 2024. 2025, it's showing us that it is back 56.6, but the 20-year average is somewhere around 78 points for consumer sentiment. So we can see that the consumer sentiment numbers are doing okay, but still not where I'm sure people in the US would like to see them. I'm sure not where the administration would like to see them. Our last chart for this segment shows an interesting statistic. More Americans are falling behind on their debts. There's no doubt about that. The blue-green line shows credit cards, 12.7%. It shows that people are falling behind. 12.7% of those that took the survey are telling us that they're falling behind. 9.57 is an interesting one. Those are student loans. Then you have autos at 5.2. You have looks like other at 9.5, and home equity that's 0.82. That's the lowest. So once again, people are starting to fall behind paying off their credit cards. There's a lot of debt there, and that makes banks a little bit nervous because obviously they want people to pay off their debts, and at some point, that's why the banks increase their allowance for bad debt, especially when the economy is struggling, because they anticipate people defaulting on things such as credit cards. So overall, how's the US economy? Well, I think you can make a case for it doing fairly well. You can also make the case for it softening. And so I would say, if I had to put it in one word, I would say it's just okay right now. I guess that's probably the best way to say. I know it's not a financial term, but if you had to describe it, you would say the economy is doing okay right now. Can it do better? Will it do better based on the stimulus that is coming down the pipe with respect to what President Trump has been saying? No tax on tips, no tax on overtime, things like that, being able to have certain tax write-offs that they did not have before. That could be a big positive. Can AI have a positive splash for the overall economy as well? Quite possibly. And obviously, I think when we get an end to the current war in the Middle East, that too will be a nice positive for the market. So for now, U.S. economy, I think, is doing just fine, but I think better days may be ahead. At least that's the hope for the current administration. Quick hits. These are three things that have been in the news recently that I wanted to comment on for all of you. New York Fed's Williams says tariff burden falls overwhelmingly on U.S. businesses and consumers. That was a CNBC article. Prime Minister Carney signs deals worth billions in diplomatic breakthrough with India's Modi. We know our Prime Minister went overseas and is still overseas. Last I saw, I think he was in Australia trying to make deals for Canada. Anthropic's AI model, Claude, gets popularity boost after U.S. military feud. With these AI models, there is definitely a component of security, compliance, whatever you want to call it. They have their own rules, and they are unable to do unethical things. And I think we'll talk about that in a second. But Anthropic had a bit of a run-in with the US government because of the rules that Anthropic has. So our first quick hit is actually, we have a quote from, once again, John Williams, the head of the New York Fed. We've had quotes from him in the past. And he says, once again, my current estimate is that to date, the increase in tariffs have contributed around 1/2 to 3/4 of a percentage point to the current inflation rate of about 3%. The FOMC defines price stability as 2% inflation over the longer run. Owing to the effects of the tariffs, progress toward that goal has temporarily stalled. So even though President of the United States would say, and perhaps many in his administration would say, tariffs are not keeping inflation higher, the head of the New York Fed believes otherwise. Our next quick hit, which is about our prime minister going to India and making some deals. We have a chart kind of outlining the deals that he has made. He has made 5 memorandums of understanding, and these are basically the legwork, or they set the groundwork for upcoming new contracts. They set out what both sides are responsible for in the upcoming contract. So a positive on the way to having a contract. And there's a commitment to sign a free trade deal by year's end between Canada and India. And they actually did sign 10 commercial agreements totaling more than $5.5 billion. A very big positive, because as we know, Canada did not have for a long time under the Trudeau administration a good relationship with India. Our last quick hit is this one about Anthropic, the AI model Claude, and that they become more popular because I guess they stood up to the US government. The US government wanted to use AI Claude for certain purposes. We're hearing to monitor individuals in the US, kind of big brother watching sort of thing. And Anthropic said, unfortunately, that is not what our business is all about, and we do not allow this. And so they do have a set of rules and guidelines that they go by, and that was, I guess they came at odds with the US government. Our one and only illustration is for this one. There you have it. At the start of 2026, Claude was number 42 on the App Store in terms of visits. Today, it's first for the first time ever, I guess, surpassing ChatGPT. And that is because I guess people are excited that they were able to stand up to the US government. So 3 things that I've seen in the news recently that I wanted to comment on. I'm sure many of you have seen these things as well. What's my take? Part of the show where I take at least one question from the audience. And I think this is an interesting one. I think it goes with the theme a little bit of our show. I've heard businesses that can't be disrupted with an AI agent are a good place to invest. Should I shift some of my investments into fast food chains, for example, or other businesses that are less likely to be disrupted by AI? A great question. But my question would be to this person, how do you know that certain businesses cannot be disrupted by AI? Who would have thought that the trucking industry would be disrupted? Lawyers, legal would be disrupted. There are many parts of the economy that have been affected that you would not have guessed would have been affected. And I think there are going to be many more parts of the economy that will be affected going forward. So very difficult to make your investment strategy based on that. I think what you need to do is look at each individual investment idea on its own. And then you have to look at where it's trading, whether it's cheap, and look at the story behind it. Does it make sense to own this name in the economy that we're in today? And so I think if you take that approach, that is much better than to segregate businesses that you think will not do well in an AI world versus those that will do well and won't be affected by AI. I think that is a lot more difficult to figure out. So with that, I want to say thank you to everybody that joined in on our show today. As always, I hope everybody took away something. I was able to answer at least one question on the minds of all of you today. I also want to say that we will be back 2 weeks from today, same time, 12 noon on Wednesday, March the 18th, where we will talk about, I guess, the latest goings on in the markets. We'll see if the war is still on, or perhaps resolved by then. We'll have to see how things go. We'll see where the markets are at, and we'll see what the next best ideas are for all of you. And so with that in mind, I want to wish everybody a happy investing.